Recently, there has been a surge in the popularity of covered call funds, prompting companies to introduce new ones. While many of the widely used covered call funds, such as QYLD, JEPI, and XYLD, employ an index-based strategy, there are now some single stock-based covered call funds emerging. Out of these, the most sought-after one is TSLY, which has experienced a huge increase in total assets from $6 million to $369 million in just a couple of months due to high demand. TSLY fund is unique in that it sells and writes covered calls against Tesla stock, TSLA, to generate yield. Based on information from its website, TSLY has an annual yield of 59.96%, making it an attractive option for those like some of my friends considering living off its distribution. Assuming you need $4,000 monthly living expenses or $48,000 annually, and TSLY stocks are priced at $15.85 per share, the annual yield is $9.50. To generate a monthly income of $4,000, you would require 5,052 shares. The total investment needed to rely on TSLY's distribution would be $80,074. However, it is wise to conduct additional research before making any decisions, as it may seem too good to be true. The company YieldMax, which created TSLY, has introduced new funds based on individual stocks, such as APLY, based on Apple, and NVDY, based on Nvidia, among others. Additional funds like these are expected to be launched soon. Since these funds deal with single stocks that are highly volatile, their dividend yields can be as high as 50 to 60% during periods of high volatility. This contrasts index-based covered call funds, which typically yield around 7 to 9% in normal conditions and 10 to 12% during high volatility periods. These single stock-based funds are becoming more popular due to their high dividend yields. Many buy this fund solely for its high yield without fully comprehending its purpose. Investing in this product does not necessarily require expertise in the options, but it's crucial to have a basic understanding of what you're buying and its potential impacts. It's worth mentioning that if you were an options market expert, you might not need this fund as you could sell your options. Thus, this fund is advantageous for those who lack knowledge or experience in stock options but want to participate in profitable trading. To keep things simple, we'll give a brief concept of how TSLY works. To benefit from a rise in Tesla stock price, TSLY purchases call options while selling put options to collect premiums that can be used to fund the call options. This is also how they create synthetic long exposure to Tesla. The put options expose TSLY to the full downside risk if the Tesla stock falls. These two positions enable TSLY to replicate TSLA's performance without investing directly in its common stock and requiring a significant amount of capital. When you buy TSLY, you bet on the performance of a single stock, TSLA, rather than a collection of stocks or an index. This can be incredibly risky but potentially very lucrative if Tesla performs well. However, the future performance of Tesla cannot be guaranteed. People will debate its performance for a long time. This heightened focus on Tesla leads to greater fluctuations in the market and higher prices for options. Consequently, investing in a fund like this, including a high volatility stock like Tesla, can yield impressive returns due to its high volatility. Usually, funds of this nature tend to raise dividends when volatility increases and reduce them when volatility decreases, as volatility is their primary source of income. The popular JEPI, a covered call ETF, previously used the same approach. So it will not be surprising to see big dividends rise or cut in the future. This fund differs from other covered call funds due to its unique approach. Unlike traditionally covered calls, this fund uses a synthetic methodology. The only purpose to use this method is to avoid leverage and use less money to trade call options compared with the traditional way. The fund has an active management approach with a gross expense ratio of 0.99%. However, even with skilled management, mistakes can occur. This means that the management may have missed out or will miss out on some opportunities due to the sudden rise and fall of stocks. It's also important to know that TSLA stock may experience sudden surges, prompting fund managers to adjust their options to maximize profits. However, unexpected events like a massive product recall by Tesla could also cause a sudden crash, resulting in significant losses for the fund. It's essential to be prepared for these scenarios and make informed investment decisions accordingly. Actively managed funds can have pros and cons. Success depends on knowledgeable and wise fund managers. Be prepared for the potential risks and rewards of active management. Based on TSLY's holdings, it appears that the fund strategy involves keeping a large amount of cash on hand to serve as a buffer. However, rather than holding cash, the fund primarily invests in treasuries to preserve its wealth. In the event of a significant drop in Tesla's stock price, TSLY may need to utilize its buffer to cover any resulting losses. In certain extreme situations, the buffer requirements tend to increase, exacerbating the situation and limiting the potential for TSLY to rebound. Many people avoid high-yield investments because the payments may not be sustainable over long periods. This is particularly true for companies in the later stages of their business cycle. Some new investors may fall into yield traps by failing to consider the long-term viability of the dividends. When looking at the charts of Tesla and TSLY, it's clear that these two assets have a strong correlation in the short term. This suggests that TSLY's share price hasn't done as well as TSLA's. But it's important to remember that TSLY has paid out distributions monthly. When we factor in total returns, TSLY still underperforms Tesla. This fund is a variation of covered call ETF. It is a common understanding that such funds do not perform as well in situations where the underlying stock experiences a sharp increase in value. This is not a surprise to anyone who understands these types of funds. Investors who invested in covered call ETFs should be aware that the TSLY ETF transforms the potential gains of Tesla stock into option premiums that are distributed as income to its investors. The upside potential is limited in exchange for cash distribution during significant market rallies. Additionally, investors should note that covered call ETFs still carry full exposure to the underlying risk of potential market downturns. As a result, they may share losses with Tesla while potentially missing out on gains. If you plan to live off dividends, it may be best to avoid investing in this particular ETF at this time. At this point, TSLY appears to be too new for us to confidently determine whether it is a wise investment or not. We may need more time to assess its potential under different market conditions. If you hold TSLY for the long term, there's a possibility of experiencing lower total returns due to potential down months when Tesla may suffer significant declines. If you're interested in buying shares of TSLY, it's a good idea to do it gradually. Many online platforms don't charge fees or commissions for stock trading. You can even buy one share at a time, which can help maximize the benefits of dollar cost averaging. Try to buy more shares when the price drops and buy less or stop buying altogether when the price goes up. Another way to limit the risk of the ETF is by controlling your positions and diversifying your investments. Warren Buffett once said that diversification protects against ignorance. But it is widely recognized that most people like us are ignorant when encountering something new and uncertain. Therefore, it is vital to learn how to protect ourselves.
We appreciate your watching. Please hit the like button below if this video helped you in any way and don't forget to subscribe to the channel. Thanks again and see you next time.